Hello, all, and welcome to today's Risk Out workshop, Navigating Compliance Challenges for FinTechs. We are so excited to have you here for Risk Out's first ever workshop. We've got some really great experts on our call today that will be walking y'all through not only some background on what the industry looks like, things you need to know, and some market trends around FinTechs, but also diving into some hands-on exercises that y'all will be able to do alongside these experts. If you look on the right side of your screen at that go-to webinar control panel, there are a couple things I will draw y'all's attention to. So first, we do have a questions section. If you click on that drop down, that will give y'all the ability to ask any questions that might come up at any point during the session. We really do want this to be an interactive workshop for us over these 90 minutes here. So we highly encourage you, if you do have anything that you'd like our experts to ask, go ahead and drop it there and we'll field as many of those questions as possible. If we are unable to answer your questions during today's workshop session, we will make sure that we will follow up with you after today's session to ensure that you feel confident on the next step of your FinTech compliance journey. The next thing I'll draw your attention to is that we will have a couple of polls going on during today's session. Those will pop up during the session as we move through some of our slides. We do ask for you to answer as many of those as you feel comfortable with, as they do help us better tailor our presentation to make sure that we're meeting your institution where you're at today. Finally, we do have handouts. We actually have a full house of 5 handouts there for you. As you'll see, those first 3 are going to be numbered. Those go in order of the exercises that we'll be executing today. So that's your policy template. Then we're going to go into the risk assessment, followed up with that ROI calculator. In addition, we have a PDF version of today's slides. So if you'd like to download that and follow along with us or take any notes or just save them for your own records, we encourage you to do so. And then finally, we do have Jake Webb, who is joining us today. We have the Web Strategies one sheet as that 5th and final handout there. He has been very kind to join us on today's session to provide his expertise with an extensive FinTech background. So definitely want to make sure that you have the ability to get in touch with him as well after today's session. Thank you for those logistics. Let's go ahead and look at the next slide here. And we are excited to tell you about the next workshop that we're having. So these are the first 2 workshops that Risk Out will ever be hosting. We've got our whole compliance team that has put together some really extensive deep dives like the one that you'll be experiencing today. While today is all focused on FinTechs, if you come back on July 18th, we'll be doing a very similar 90-minute session on cannabis and how to handle cannabis-related businesses in the program at your financial institution. So it's going to cover a lot of the same items, an ROI calculator. We'll have those policy templates and as well as a risk assessment and run through exercises for all of those as well. So feel free, if you download those slides, you can click that button to register today, or you can always find the registration links for all of our sessions and more content at riskout.com. With that, I will go ahead and throw it over to our experts today. Brian, Kristen, and Jake, take it away.
Good afternoon, everyone. Thanks for joining. I'll get right into kind of our team here at Risk Out. So myself and Kristen here on the line. Myself, I'm coming to you live right outside of Philadelphia. Yes, the team that beat the New England Patriots with a backup quarterback in the Super Bowl. I've been here now with Risk Out for about 3 months, 4 months as a senior compliance specialist. Prior to that, I served in the bank examiner role at the Federal Reserve Bank of Philadelphia, and then went over to the other side in the public accounting consulting realm, where I spent a few years there. So I'll pass it over to Kristen and then Jake as well.
Hi guys, I'm Kristen Parker. I'm based out of Asheville, North Carolina. I am the VP of Operations and Compliance over here at Risk Out. I've been in banking for 20 plus years now, and my focus has traditionally been on the BSA AML compliance side. I did have some front of house experience for a little bit, and then moved over to BSA AML compliance and fell in love in the geekiest way possible. And now I'm here today getting to consult with a bunch of different institutions all over the US, learn best practices, educate regulators, try to be a good thought leader in this land so I can help with the education pieces that I know are significantly lacking in these areas. I know when I was a BSA officer, there wasn't a lot of good accessible content to go through from a real tangible standpoint. So our hope here today is to give you resources that you can actually use, and it's not just us talking at you. So I hope that you are interactive during this process, that you ask all the questions until you're blue in the face, because we will get to as many of them as we can, because it's important to me, it's important to us that you get the education you need to be actually effective at your institution. So let's make this as collaborative as possible. Jake?
Thanks, Kristen. Great to be here, guys. My name is Jake Webb. I started Web Strategies after 11 years in between the banking and fintech industries. So I've gotten to work on both sides of the high-risk banking relationship. I was an early student of Risk Scout. In my banking days, I was one of Risk Scout's first clients when we handled cannabis banking, and then transitioned over to lead banking and payment strategy globally for a major crypto exchange, blockchain.com. And so my goal with Web Strategies is to really be the translator and kind of bridge that gap between banking and fintech. So I help fintechs at all different risk profiles kind of get their compliance and financial infrastructure ready to present to a bank so that they can qualify, pass your enhanced due diligence, maintain healthy relationships. And then I work with banks on setting up high-risk banking programs so they can serve those customers with a really heavy focus in the digital asset and cryptocurrency industry. Yeah, so great to be here.
Awesome, awesome. Thanks, Jake. Thanks, Kristen. So if we go to the next slide here and talk about what we're actually going to go through today, and to echo what Kristen said, this is supposed to be very interactive. We're on a tight timeline, so hopefully in 22 minutes we'll be done with the slide deck completely, and we're going to go right into screen sharing, where we're going to go right into a policy, risk assessment, and an ROI calculator. So for now, before we get into the screen sharing, we're going to go over some fintech statistics. We're going to go over some of the types of fintech relationships, how do we manage those fintechs, and then obviously the ROI calculator that I previously spoke about. So I am going to pass this over to Ethan for our poll question.
Perfect. Thank you so much, Brian. As I mentioned, we will see our first poll question coming up on the screen currently. That's just to get a feel for our audience today, and that asks, what percentage of your compliance resources is allocated towards identifying target customers based on risk tolerance? Your options there are under 25%, 25 to 50%, 51 to 75%, or more than 75%. We'll give you all a moment here to go ahead and get your responses in, and then we'll share those out and see how that aligns with the rest of the audience. All righty, y'all are quick on the draw today. Looks like we've already gotten most of our answers in. So we'll go ahead and turn that around and share out those results. Brian, it looks like we had the overwhelming majority say less than 75%, but we did have a few responses that are kind of in that lower area, as well as one that is over 75%. I'm curious, how does that stack up to what you were expecting to see?
Yeah, I mean, I think we have a great audience and very diverse, you know, and it should hopefully lead to some interesting conversations. What are you thinking, Kristen and Jake?
You know, the key word that I keep hearing with banks lately is risk off, especially in 2023 with some of the economic climate. And so it doesn't surprise me that a lot of banks have answered less than 25%, because I think a lot of banks are just saying we're going to focus on kind of our core base of low risk customers. But it's really encouraging to see some people answering in the more than 75% of the 25 to 50% range.
Perfect. Thank you all so much. We'll have some more polls coming up down the road.
Awesome. All right, so the next slide here is just talking about some facts, right? So I don't think it's a surprise to us that you know, fintech is not going anywhere. The technology is only increasing, and as we can see, you know, as of 2021, there were nearly 9,000 fintech startups in the United States. And the projected, value, globally is expected to be 324 billion by 2026. So just like cannabis, it's probably not going to go anywhere, and it's only going to continue to evolve. Kristen, anything to add to that, or Jake, before I go on to the next one?
Well, I would just add there that, the word fintech is so broadly used, right? Sometimes we hear it as banking as a service, sometimes we hear it as fintech. So fintech, the definition of fintech can be so broad in nature. So I think it's important to understand what a fintech is in regards to specific, examples. So we'll go through that here shortly, but I think it's important we define that fintech doesn't necessarily mean that you're offering financial services on behalf. They're not linking up with an institution to offer financial services. So that number 9,000 is really big, because it could be a number of things. RiskOut is technically a regulatory technology company. We don't offer any type of exchanges or financial services through RiskOut. So we do fall in the definition of fintech. Banking as a service is probably sometimes a better term. I think the last stat I heard was around 600 banking as a service companies that actually have relationships with institutions that are using institutions to run and be the facilitator of those transactions on their behalf. So I think it's important to say, okay, whoa, there's 9,000. Yeah, that's true. And a lot of them are vying for institutions to be their backer. So it's important to know that there's different types of fintechs. There's that term turned around a lot, but 9,000 is quite a big number. Right now, there's only about 600 that are linked up with actual institutions from last we heard, and I think it was Q2, but that means that there's bukus more out there that are looking for homes. And we hear all the time talking to institutions and different middleware companies and whatnot of how many fintechs are just itching to get into an institution or looking for a banking as a service type relationship.
And I'd add, kind of on top of that, there's a whole different range of risk profiles within those 9,000 fintechs too. So, I tend to focus on the digital asset industry, which tends to be at the very high risk end of the spectrum. But if you're interested in getting involved in banking fintechs or investing in fintechs or using fintechs as part of your product suite, there's a whole array of risk profiles that kind of match your risk tolerance.
Awesome. Thank you both. So going to the next one here, kind of branches off of what you said as far as, they're looking for homes, right? And that's because many Americans are using them, right? 9 out of 10 Americans now use some sort of fintech app to manage their life, right? I mean, I know for myself, I've been an avid user of Mint, right? For probably a decade now. So that's me personally. And then, a shocking fact was that baby boomers are the fastest growing segment, right? And to me, I feel like it would be the millennials, but I can't go, based off of my opinion. So, why do people use them? And as we can see, it says to save them time. I mean, for me, I don't want to go, if I have 13 accounts at 5 different institutions, I don't want to have to go and log in through each account. I think many of us could agree with that. Anything to add before I move on to the next one, gang?
I think the baby boomer section is telling, and a lot of that adaptation had to come from the pandemic, right? You didn't have a brick and mortar branch to necessarily walk into, so you pushed people more that way. But when we think about fintech, there may be things like Mint, who it's great to utilize different, plugins, APIs from different institutions into one whole, unit to use. But there's also different versions of it, like your embedded finance, right? So when you go to check out and you're offered a firm who will finance your $200 payment into $20 trunks, with whatever interest, there's all these different versions of fintech that exist out there that a lot of people don't even know that is defined as fintech. So I think, we're just kind of naturally being shoved in, there's such an adoption rate to it because it's literally in almost every app you're using, right? If you have the option to offer payments through apps, that's technically a fintech, or they're using some bank to facilitate those on the other end. So it's kind of the way how quickly society wants to move now. People are having to adapt and get creative, and now they want it right in front of their face. So I think it's important to keep that in mind, that there's lending companies, there's payments companies, there's just nice to haves like Mint, right, who are there to help you untangle the web of 13 different accounts in different places. So while some of them may be driven towards consumer habits, others are more convenience factors.
Awesome. And then from just a consumer expectations per the Plaid report, 80% say it's important that they're able to connect their bank account to some sort of app and service. I know from my perspective and a lot of family and friends, it's one of those determining factors when trying to select a new institution. There's a credit union very close to me that, as far as location, that they weren't able to integrate with a Mint or a PayPal or a Truebill. And then when they finally were able to, because of the amount of people that left the financial institution, they got a program where you had to get a code sent every time you wanted to check the app, instead of it just being one of those automated processes. 76% said that, that connecting to that fintech was a top priority in choosing a bank. Again, kind of echoing what I said from my family and friend perspective. And then 69% saying that they would actually consider switching banks. And I think, for at least, my circle, that it's the same thing. I mean, no matter where you go, what service you're using, you're always trying to get some sort of enhancement to save you time and have that reliability. Anything to add on the expectations there, team?
Nope, I think you nailed it.
Yep, awesome. And then from the fintech perspective, well, what can they do, right? What we've been talking about is the enhancement, right? There's more and more fintechs coming out, and they're trying to make things more faster, streamlined, and make it where it's solving a problem that most of us, encounter, whether we've identified it ourselves or in another way. It can provide access to new markets, right, and different types. A fintech can also, on the other hand, get some scrutiny, right? I mean, it's no shocker. I mean, that's probably why most of you are on this workshop, that there can be a lot of regulatory scrutiny when it comes down to it. And it's also something where, because of this evolution, it doesn't stop changing, and we have to continuously be up to date and make sure that we all understand, what the regulations are behind it and such. Anything to add?
I would just add that I think it's important to also just define for the audience here that having a fintech relationship at your institution is, from a partnership or offering additional services to your own client base, just making life easier through like a Zelly or one of those services people enjoy, isn't the same as sponsoring a fintech to run their run their transactions on their behalf. There's two different things here. So RiskOut, being a regulatory technology company, the risks of partnering with them are very different than it is a Zelly or a embedded finance company where you're running transaction, that bank or credit union is running transactions on behalf of that fintech, facilitating those transactions. So there's two different risk profiles. Today, we're talking about the latter half. So we talked a lot about the convenience of fintechs, and there's certainly purpose in partnering with fintechs from the perspective of, offering more services and products to your own institution customer base, especially if you're a community financial institution. In order to keep up with the bigger guys that move quicker, a lot of times you do have to partner with them, but it doesn't mean that you're necessarily running transactions on their behalf. They may just be facilitating, some movement of money, and they've got a sponsor bank somewhere else. If you're the sponsor financial institution for a fintech that you are helping facilitate money movement, do any of that type lending, that's different risks, and that's what we are focusing on here today.
Yeah, so I think I switched the slide there, Kristen. So if you wanted to tackle that, since you just hit on that, the sponsor.
Yeah, so a sponsor financial institution provides the regulated financial services directly to the recipient. So basically you can think about it as, there's so many fintechs out there that want to facilitate money movement, but it's a lot of money and it's a lot of work to get a bank charter or a credit union charter, right? So they partner with financial institutions to facilitate and use their charter to run their transactions. So those present very different risks. The fintech vendor user is what we were just talking about. So if you were to use RiskScout to help facilitate and make your lives easier on your compliance perspective, then that's a different type of risk, right? Very little risk involved in that because we're a vendor who's helping automate a lot of processes for you, help you cut back on your staffing expenditures, automating different feature sets, all that, but we're not facilitating money movement for you. We're not using you as a bank charter. And then the fintech investor, which we see a lot of these in the credit union space, is somebody that utilizes their investment strategy to invest in fintech companies. So they are directly funding fintech endeavors, or maybe they are a part of a pool of investors that invested into a fintech company. So those risks are completely different, but we're going to be focusing on the sponsor financial institution as part of this workshop.
Oh, another poll question.
It's that time again. Perfect. We'll go ahead and launch our second poll question, which should be on your screen now. And that is one where you can select one answer to answer which tech capability do you consider the most essential for supporting your financial institution's compliance efforts. We'll give you all just a couple seconds to get your answers in here. You could select online banking services, APIs, data analytics tools, or regulatory reporting software. Alrighty, seems like we got a pretty even split here so far. Oh, well, look at that. All right, we'll go ahead and share out our results. They should be on your screen now. And it looks like we had a dead even split in our audience here, a good amount of responses, but still data analytics and regulatory reporting are 100% tied as the most important item, whereas online banking services and APIs did not get any recognition as the most important tools. Brian, what do you think about that?
Well, from being the former examiner, I do like the fact that 50% have regulatory reporting software as their choice.
Yeah, but the other 50% need those tools, right, to be able to analyze from the BSA perspective. So I think it's fair. I mean, I'm not surprised at all that there's a 50% weighing on here. Maybe there's some people in audit in here, and then maybe there's BSA officers.
Perfect. Thank you for responding.
Yeah, and I want to make a quick plug for APIs really quickly. Not one that you usually associate with compliance functions, but I've seen institutions, eliminate, a lot of lift on the customer service side of a debit card program, for example, as it relates to disputes and things like that, by using APIs to connect to different partners that they have and really automate that process. So those can offer some value on the compliance side as well.
Thanks, Jake. Is this coming up as blank? Oh, okay. Sorry about that. All right, awesome. So for this next slide, what is going to be the strengths that come from an FI and a fintech relationship? And as we can see, when we're looking at this partnership, it's really about improving efficiency. It's going to be providing you with more accessibility of products, and then enhanced risk mitigation. Because again, when there's the partnership, everyone has their strengths and weaknesses, but it's all about making sure that at the end of the day, sorry, I just lost my train of thought, that we have the appropriate risk management and tools in place. But I'll throw it over to Jake and Kristen. Sorry about that.
I mean, I'll add here that, coming from a community banking background, a lot of times our technology is, out at best a decade, if not sometimes more further behind than the big guys. So the easiest way to, bring some services to your institution is through FinTechs, right? And so, from the sponsorship FinTech perspective, you can still offer those and offer innovative ways to your own customer base, but you also get to tap into their own customer base. So you're being able to tap into markets that you previously would have never had access to. And then on the FinTech side, they have, a lot of times they're a lot more innovative. They have more staffing that is driven towards, the quick turnaround time of updating and being more nimble in the fact that they have the developer staff to be able to shift quickly when the market changes, than what an institution. If you want to think back to like when the pandemic happened and the PPP loan debacle that happened, and then all of a sudden these tiny little community financial institutions are taking 1,000 calls from businesses all over the place, and there's no easy way to do it. There were FinTechs out there that quickly were pivoted, were able to, get some software together, make their own software, change differently, and put it in the hands of these institutions so that they were able to rapidly take on those that request for loans and processes, PPP processes. I say that because in the community financial institution side, that you can't, pivoting that quickly just typically does not happen. So there is definitely a disruptive market mindset too in FinTech. So the more innovative, the more creative they get, the more access they have to markets that would have previously not been out there again. So I think it's, the modern IT systems, that whole piece is just stuff that, if we really want to be honest with ourselves, that community banks and credit unions are typically working on cores that are 20 plus years old, BSA systems that are 20 plus years old. So tapping into the FinTech market and giving them the ability to have access to an institution as a charter to be able to get out there and grow their customer base just means the more innovative they can be because they're able to grow their revenue internally.
Jake, anything you want?
Well said. Yeah, I think Kristen, you nailed it. So
Awesome. Awesome. And then Jake, I will hand this over to you.
Gotcha. So the FI sponsor relationship, and we can kind of walk through this real quick, but the idea is, so a lot of FinTechs, they need someone behind them, someone with a banking license, someone that can hold deposits. Oftentimes that means money transmission services and things like that. And so that's where a sponsor relationship really comes in. And so you can either deliver those services directly or indirectly. Directly where you provide it directly to a prospect FI, or where we got into licenses and money transmission, right? You're providing that service to the FinTech, and they're running on top of on top of the infrastructure that you've already developed. Depending on how much legwork you want to do on the compliance side, one or both of these options might be best suited for you.
Awesome. Anything to add on that, Kristen?
No, I think we just get through the rest of these slides so we can get right into our policies and risk assessment.
So I think this is a good one, Kristen, if you want to just briefly review from our end, and then we'll just go on through.
Yeah, absolutely. So I've spoken many times about how there's different sponsoring a FinTech and then utilizing a FinTech at your institution as just a vendor partnership is much different, two different ways to utilize FinTechs in that perspective. So here's an example of risk out in the perspective of we're a regulatory technology company. So we fit right into the regular flow of the institution's workflow, but we add additional assets an ability to monitor appropriately. This is just a really good, quick example of how FinTech is a partner in the perspective of how you maximize your efficiencies at your institution. But we're not here and you see none of these little circles here are us managing any type of financial transaction, not managing, but facilitating any type of financial transactions that the institution is ultimately responsible for ensuring applies that compliance and BSA regulatory requirements are met for those transaction monitoring.
Awesome, thank you. And then Jake, if you wanted to touch on this.
Yep. So we'll run through this one really quickly. Earlier, I mentioned that there's a whole different of the 9,000 FinTech startups that are out there. There's a whole bunch of different risk profiles that kind of match what your risk tolerance looks like. And so when you're identifying your target FinTech, especially if you're offering banking services to them, whether it's depository services, or they're running on top of your infrastructure to provide their services, just some things to think about. I'll let you guys read this in the interest of time, but there's a few things that I want to call out here. Jurisdictional risk is a big one. A lot of FinTechs operate internationally. A lot of them aren't based in the US. And so one of the things to really consider is how well are you set up from a compliance perspective to handle those different jurisdictions. Think about industry activity. What function are they performing in the industry? One thing I always tell FinTechs when they approach a bank is show me, don't tell me. And so look at their flow of funds, look at their sources and uses of funds to really identify what type of FinTech they are, what risk profile they are, and how comfortable you are with working with them. A big one when it comes to with products and capabilities, this is really big when it comes to wanting to provide deposit services to FinTechs. One that's on here that I really want to call out is deposit insurance products. The number one thing I hear from FinTechs all over the place is who can insure more than $250,000 of FDIC insurance. And if you have an ICS or a CEDARS product in your product suite right now, you have a leg up on everybody else. When this year alone, we've seen 4 of the major FinTech banks fail. And so when SVB failed, I think my phone rang until 10:30 that night, and the number one question was, where can I move my money where it's fully insured? So if you have 30 seconds to meet with the FinTech, introduce yourself for 2 seconds and talk about deposit insurance for 28 seconds, because that's probably the most important thing to a lot of them right now.
Awesome. Thanks, Jake. All right, awesome. So I think we're going to cover this in our screen sharing, but I pretty much.
Yeah, we'll talk about this section during a lot of this during our actual policy and risk assessment process.
Jake, do you want to touch on this real quick?
Yep, sure. I can scoot through this one pretty quickly too. So a big part of offering banking services to FinTechs and really analyzing the applications that you get is you got to ask the right questions. And so, we talked about identifying your customer, but part of it is identify the risks to your customer. So, I spend a lot of time in cryptocurrency. One of the big things banks look for is liquidity. That's a big problem a lot of exchanges have had lately. So what are the risks that your customer is facing? Identify those and then figure out, what do I need to ask for to make sure that my customer is mitigating the risk properly? We talked about looking at sources and uses of funds. I always tell banks or tell FinTechs, send a bank your funds flow diagram. Nothing with 50 bubbles and 50 arrows on it. You should be able to draw it on the back of a napkin in 60 seconds. And if you can't, then it's way too complicated. So that's a big one. Right size compliance is huge. I've seen banks ask for the world from FinTech customers. And it's difficult for the customer, but it also means that if you ask for it, you have to review it. So just make sure you're asking for the right things, but also enough to cover your bases. Monitor industry trends and market events. We saw this one was a really big deal starting in about October, November in the digital asset industry. Make sure you understand what's going on in the industry that you're or the kind of subset of fintech that you're working with. And as those industry events come up, you're going to make sure that you go back to those customers and ask, how are you handling this? How are you dealing with this? That was a big trend after we saw like FTX and Terra Labs and Three Arrows, all that stuff kind of collapsed last year. All the banks went back to their customers and said, what are you doing to handle this? And then the last thing I'll add here is leverage regulatory agencies, because they're probably already doing some of the same due diligence that you are. So a great example, if your customer has a money transmitter license, every state that they have that license in, the State Department of Banking is examining them on an annual basis to renew that license. So if they're looking at a lot of the same things you are, oftentimes just to validate your own due diligence, you can look at the results from those exams, or did they renew their license, things like that, to kind of validate what you're already doing.
Excellent. Awesome. And then another poll question.
Excellent. We have that up on our screen now. And that asks, how challenging is it for your institution to navigate compliance in high-risk markets in multiple jurisdictions? Go ahead and put your answers on the screen. Those options are extremely challenging, moderately challenging, slightly challenging, or not challenging at all. Give you all just a couple more seconds. Get your responses in here. All righty, and you should see those coming back up on the screen now, where you can see most of our audience, of 50% to be exact, said that moderately challenging. It's moderately challenging for them to navigate compliance in high-risk markets. About a third said extremely challenging, and 17% said slightly challenging. No one finds it not challenging at all, which is not particularly surprising. Brian, how does that strike your ear?
I was going to echo the same thing, as it's really not surprising, and I would definitely agree with the moderately challenging, you know.
Yeah, they call it high risk for a reason, don't they?
If it wasn't challenging to you, I would be very concerned, right? Because it's its own job in of itself, right? Understanding the markets and that which your institution has decided to bank. If you are doing that manually yourselves, can be a very difficult and challenging process. So we'll talk a lot about through this and in the policy and risk assessment build.
So for the interest in time, do we want to get this last poll question answered, and then we will we'll just breeze through those remaining slides and do the screen sharing?
Absolutely. So this is our final poll question today, and that does ask, what percentage of your compliance budget is currently allocated towards compliance training and education for your employees? Those are the same options as our previous percentage question of less than 25%, 25 to 50, 51 to 75, or more than 75. I'll give you all just a couple more seconds in the interest of time before we go ahead and share those answers out. All righty, we've got most of our respondents already in, and it looks like 57% find that they're spending 25 to 50% of their compliance budget just in terms of training and education, with the rest of our audience spending less than a quarter on that education for employees. Is that pretty traditional to what y'all see in the market today?
Actually, I would say that that 25 to 50, if it's closer to 50, would be surprising to me. You know, I've worked at community financial institutions with smaller budgets, so if you are investing in your employees like that, kudos to you, because it is becoming more and more important in this day and time to continue to stay abreast of the ever-changing environment that we work in. The challenge can be is that you get in education areas, you get into training sessions that are just all talk no show, or just talking heads that haven't been there before. We try to not do that to you guys, provide you guys traditionally much more comprehensive training that's actually useful when you go to bring your cheeks back in those seats.
That was really encouraging for me as well, because I think oftentimes your first line of defense for any kind of compliance related issues is not your compliance team. It's your customer service team, it's your frontline team. And so investing a lot in training, I think, is really beneficial. So that was excellent to see.
Awesome. Jake and Kristen, do you want to take this slide?
Sure, I can speak to this one just really quickly because I've been a user of Risk Scout before. And I can tell you that when we launched our cannabis banking program at Keystone Bank, it would never have happened without Risk Scout. The application process, the review process, when we looked at what that would take for us to do manually in-house, it was hiring 2 to 3 FTEs. It was a lot of time and a lot of manual inputs. Manual inputs means worse data quality. And so, you know, when we used Risk Scout, it started to automate that to where I wore a whole lot of different hats. I didn't just have to be the cannabis banking guy, but we could still run that program effectively because we had a program like Risk Scout running in the background. So that's my quick Risk Scout plug. But
I appreciate that, Jake. Yeah, and now, you know, while we do serve the cannabis banking space still pretty robustly, you know, Risk Scout is nimble enough to be able to adapt to anybody's workflow. So if you're just banking cash intensive businesses, CTR exempt customers, FinTech, you name it, we build those workflows into Risk Scout. So we can talk more into detail about that. But what we are finding ourselves doing more and more these days is having FinTech conversations with institutions who start utilizing Risk Scout to manage their FinTech relationships. So we can talk about that in greater detail, but I think it's important that we get to these policies and risk assessments so we can give these guys.
So let's get right into it, okay?
All right. I've got to share my screen. Somebody want to give me that?
All right,
option?
yeah, absolutely. Let's get that flipped over. That should be coming up for you now.
All right, can you guys see?
Yeah, we're seeing the right window. If you want to make that full screen for us. Beautiful.
Perfect. All right. So usually in this space, and I want you guys to chime in as whenever you guys see fit, and then you guys ask questions whenever you see fit. Usually,
sorry, as a quick reminder, if y'all want to follow along with us, we strongly encourage you. We do want this to be an interactive exercise. So as a reminder, we do have that handout section. This is going to be that document number 1 in the handouts. If you want to grab that, it's a Word document, so you can edit alongside us, and we'll continue forward on documents number 1, number 2, and number 3 as we move forward here.
Yep. So, well, usually in the BSA world, I get the biggest heartburn when I talk to people who have decided to do a banking program, but they have never done a risk assessment and they built their policy first. Now, I can shoot myself in my own foot now by saying in the FinTech space, we usually start with your policy and then your risk assessment. And the reason for that is by this point that we've gotten to the policy, we've had board meetings, we've had maybe committee meetings, we've had other type of conversations with key executives, our regulators, and we have decided that, yeah, we want to get into the banking as a service or FinTech space. We want to be a sponsor bank for these. Usually within those committee or board meetings, you've already decided what's your risk tolerance. And sometimes it can be pretty broadly stated to begin with. But you do know at that point, okay, we will do this and we won't do that. We're currently working with a couple of financial institutions and they've laid out things that they will not do. They will not do embedded finance. They will not do lending to start with. They will not do X, Y, Z. And so that way from there, if we build the policy first, we know we've at least put on limitations on what we will and will not do. Now, is this policy going to change more often than your annual wish that a policy would change? Yeah, probably, just to be truthful. And especially if you're starting out green and this is brand new to you, you are definitely going to have this more as a policy working document than you're used to. Now, are you gonna have to send it to your board every week? No, but there's good ways to track on the policy things that you want to update. And if it's dramatic enough because the institution has decided to shift their gears on which FinTechs they are wanting to entertain, then yeah, your policy needs to be updated between cycles that you normally would, which is typically annually at financial institutions. So when we start with the policy build, we want to do this first because we're going to know based on what we determine from here and what we've said we will and will not do is going to be how we build our risk assessment. So when we are going through this practice today, we're pretending that we are a brand new into FinTech right out the bat. we don't have any fintech clients yet. We have just decided that we want to get into this space. And so we're building out a policy first so that we can get our board members comfortable with memorializing what they have said their risk appetite is. Before they decide their risk appetite, there is a journey in educating them on fintechs and, you know, the pros and cons of banking them. A lot of times people are blindfolded or folded and see the whole, dollar signs in front of you, and because it can be very lucrative to bank fintechs. The problem lies in the fact that there are so many underlying regulatory issues that can happen that can quickly liquidate or any type of fee income you had or any type of arrangements you had in that circumstance if you don't do these programs correctly. So you need to, prior getting into the policy, you need to get in there and really truly educate yourself so you can educate them on the pros and cons and the issues that have occurred and how you guys will attempt to mitigate those risks for your institution. So when we go through this policy build, we've made this a separate BSA policy. I think it's important to keep it that way and to reference that policy within your existing already BSA policy. And I say this because I just mentioned how this is probably going to be more of a working policy than in your first year or two than it is going to be one that you just update annually and have the board's blessing on annually. So it's really, really important that you guys, to me, keep this and as a separate reference document from your BSA policy for that purpose. You may eventually, as you guys get more comfortable and get, decide that you're only going to stick with 2 or 3 and you're comfortable with those and, you're not going to add any more and so on and so forth, maybe you could marry this into your existing BSA policy. But again, for sake of your sanity, you might want to just keep this separate. We're going to walk through each of these sections of the policy template and share instructions and best practices. You have this policy as one of your handouts. If you guys get into a situation where you don't even know where to start, you can reach out to RiskOut. We'll give you guidelines of where to start even further than what we're giving you today. Sometimes it's good to see one that's already been mocked up by an institution. Sometimes we'll share redacted ones that we've done before. That may be a good start for you. I prefer that you guys take your first stab at it. We always call this kind of self-service, right? So when we're doing advisory services at RiskOut, we usually encourage self-service options, which means you get this policy template, you take it as far as you can. And if that means you only can write 2 sentences in there, that's all you can write. But it gives you some ownership to what you're writing and helps you start to begin to self-educate on the different risks and things you should be thinking of throughout your institution. If we do a white glove service for you, which we're more than happy to do, which means we do the policy from A to Z on our own, doesn't mean that you've had the right maybe key stakeholders involved in those conversations to put some ownership back on the people who will actually be managing these relationships and this program from day to day. When we talk through this, let's talk about the introduction first. You always want to lay out the why of why does this policy exist at all? And is it because you guys are thinking about maybe going into fintech, or it is a definite thing within a certain time frame? You want to just keep it clear and concise. Policies aren't meant to be 75 pages long. I have seen policies that long before. You don't want to over-engineer your policy so that you pin yourself in a corner, and you don't want to do it to where you are having to update it every week. When I say it's going to be a working document, I mean more of, on occasion. We want to keep this kind of more high level, and the fact that you kind of have a little bit of a gray area in there should things fall outside of your policy, but it's something you really want to entertain and you have to get a policy exception for. So we want to keep this as more generic as possible. Always in your main objectives area, you're going to want to explain that the purpose of this is BSA, and there may be other policies that end up having to be involved. If there's other lines of businesses that are affected by this relationship, you may have an operational policy, you may have a lending policy, you may have an audit policy. This is designed to be around BSA AML compliance. So we are going to state that in here so people clearly know that there may be other policies that exist. If there are other policies that exist that affect the FinTech review or the processes or the policies at your institution, you may also want to put references to those policies that also may be part of the program altogether. In this area, in the risk assessment area, we're going to want to talk about the concept of how we go about our risk assessment. Is it going to be done annually? Is there going to be a different risk assessment that is completed for every FinTech that we onboard? Do we have an overarching FinTech risk assessment for the program altogether? And then do we do ones individually for each one? So you want to clearly articulate the process between your risk assessments. Typically what we see is what we're going to go through today, where we do one, we start with this one overarching one that says, okay, this is the health of our relationship now, the stance of our BSA program now in regards to what we're thinking about, what we want to do in FinTech land. We start there. And then for every FinTech that we do entertain, we complete another risk assessment. So it's specific to the risks that are involved with that specific FinTech. You want to clearly define your CIP policy. You may be referring to your current CIP policy, but if that CIP policy does not address how you will review FinTech relationships and that customer's customer, then you need to either update the CIP policy that you currently have, or say, in addition to the CIP policy, we also have this specific set of CIP rules for the FinTech type of relationships. And that could be can be widely varying depending on the type of relationship of the FinTech you've set up. So think about this. Your FinTech is going to have its own customers. How are you going to ensure that that FinTech knows their customers? Because at the end of the day, that FinTech or that banking as a service type relationship, you're responsible for the BSA AML compliance that happens at that FinTech. So regardless of whatever your legal agreement says, if they are saying we are going to do all the CIP, we are going to do all of the suspicious activity monitoring and reporting, we are going to do X, Y, and Z, at the end of the day, you need to be testing that they are doing what they are saying they are doing. Like Jake said earlier, show me, put your money where your mouth is, basically. Don't tell me, show me. And so that is going to require you testing these relationships on some type of cadence. And we can get into that in a little bit here, but I think it's important from a CIP perspective to understand how is your customer knowing its customers, because you're ultimately responsible for that. So there's a lot to think through in that regards. Some of our institutions.
Real quick to this, if you don't mind. This is in what I see with FinTechs, especially as they're trying to start relationships with banks or providers. This is the #1 area where FinTechs fall short. A lot of the problems they experience with AML or fraud come from not having good enough CIP policies and procedures. So this is one that I would examine. Ask your FinTech, send me your AML policy, send me your KYC or CIP policy, and go over it with a fine-tooth comb.
Yeah, and I'd also say to add in this section that whatever I would point out that you are testing these on some type of cadence, because it's one thing to see somebody's written words, it's another thing to see their work. So a lot of times what we advise in the FinTech space is we have some type of reoccurring cadence that they are auditing a certain subset of their customers. So they're getting reporting in saying, we've added 100 customers this month. Well, they say 10% of us show us your CIP information and your AML monitoring profile and this, that, and the other, if that's what they say they're doing. So it's important to not just get those policies that they say they're doing, but to test to make sure that they are doing what they're saying they're doing. Some people can rip the best policies off the internet, but they don't have a clue what they actually mean. So it's important to keep that in mind. Okay, Customer due diligence and enhanced due diligence. This goes back to kind of what I was saying before. You need to detail how you're initially going to assess these fintechs. And it can't just be through your normal run-of-the-mill, even higher risk client type, application process. There has to be really enhanced due diligence to understand who this business is, who's behind it, what they're offering, what their customer base is, what they maybe the products and services they're offering, because all of that adds up to adding additional risk to your own risk profile, because again, you're ultimately responsible for all of the activity that is occurring at that fintech. So in this section here, at a high level, this isn't your procedural document. Again, this is your policy. You're going to want to say at onboarding, at a minimum, we do X, Y, Z. And for ongoing compliance, at a minimum, we do X, Y, Z. And if things, are escalated or potentially non-compliance, we reach out to the fintech and do the following X, Y, Z. It doesn't need to be detailed in the processes part, but just say at a minimum, we're going to do this to protect the institution. On suspicious activity reporting, a lot of times these fintechs will, talk the talk, but they don't a lot of times walk the walk, because they don't really understand. They can speak to what a SAR is, but they don't really. A lot of times they lack proper staffing and tools to be able to actually detect and report suspicious activity reporting. So you need to define in here what that agreement is between you have both parties. A lot of times our institutions will only partner with fintechs that have the ability to monitor for suspicious activity report, do some type of transaction monitoring. If that's the case, you should have access into that transaction monitoring system, whether it's like a Unit 21 or one of those guys that they're using to monitor for suspicious activity report. You should have access into that instance so that you can see and audit and examine what they are doing to ensure that they are actually understanding their obligations and that they are reporting upon what you all agreed upon. From the training perspective, you need to ensure that the proper employees that are involved in the fintech relationship are trained on the risks involved with those specific fintechs and all the regulations that are involved with those fintechs. That training can't just happen once, and it's a good thing we're on this call with such investors into training, because if you get into this space, you should know that you're going to have frequent training to understand where the risks evolve in these industries based on what they're offering. Audit review, I've touched on several times. You're going to want to have access into their instances. You're going to have to request information from them on some type of recurring basis to audit that they are following the program rules that you guys have agreed upon. If you do that manually, that's tough. So you want to have some type of tool in your pocket to not just be able to request the information and then be able to return it to you, but also to be able to memorialize that you have reviewed it, because if it's not documented, it didn't happen in the examiner's eyes. Record keeping is a big part of this space. We all know that 5 years, that's how you should keep it, how long you should keep documentation related to this compliance. Document in here what your typical record keeping purposes are. Policy review and updates, again, this is a living document somewhat. It's not as living as your processes document or your procedural document, but it should be updated at least annually, but probably more frequently in your first year. Any type of violations that you should be reported and escalated to the board of directors for review. There are different processes. Some institutions have committees, fintech committees, that then decide what gets escalated up to the board. There are things that have to be well thought out for the reporting violations part. So if you document during the audit that they violated some of the policies or procedures that you guys have agreed upon, there should be some type of escalation process in there for reporting and then determining whether or not the appropriate time to exit those relationships. And then that ties into consequences of non-compliance. Policy exceptions should be well defined. Who can make a policy exception in fintechs? Usually it should be way upper management in that space, because if you decide that you're going to onboard somebody, or maybe they have violated a policy and your exit plan has been triggered, but somebody doesn't want to exit them, we need to understand who has the proper policy exception process. Usually it is the board of directors that gets involved in policy exceptions when it comes to fintechs, because the risks can be greater with, from a risk and reputation standpoint from that perspective. And then you need to clearly define the role of the BSA AML compliance officers. So that means, who's involved, what their responsibilities are, that they are treated separately from, that their authority over this is different than your traditional BSA AML role, right? So that they have more authority at the overlooking of the fintech relationship and have specialized reporting to the board of directors on their responsibilities and what they're seeing within that fintech relationship. So we'll stop there for sake of time, but anybody have any questions or comments? All right.
We did have one question come in that asked, is this webinar being recorded? And the answer is yes. So just we'll send out this recording to everyone that is on the call today. So no worries at all. If you've got to drop early or if you missed a piece, you can always go back and revisit these. And as well, all the assets are in those handouts there. So thank you for that question. If you have any more, please go ahead and submit those in the questions tab on the side.
Perfect. All right. So we've got about 28 minutes left, and this BSA risk assessment is quite robust. So I'm going to move pretty rapidly through it. But again, should you guys want a separate time with me or anybody on this call to talk through it, we're more than happy to at a deeper level. You always want to start a risk assessment with the purpose and introduction and risk, the why. The why are you completing this risk assessment? In this risk assessment, it also clearly lays out that move this to a different screen, to establish clear parameters regarding the fintech relationship it intends to gauge, you guys intend to engage with. And what that means is this risk assessment shouldn't just be so high in the sky. We might bank anybody at this point, any fintech at this point, so we're going to cover all the risk in the industry. Your risk assessment would be 400 pages long. It does not need to be that way. That's why we write the policy first, and then we move over to the risk assessment, because at that time when your policy is written, you probably are only entertaining 2 or 3 different facets of the fintech, BaaS relationship world. It's also crucial that you guys remember that this risk assessment is here as a BSA AML tool. There may be other risk assessments that have to be done in different departments, such as lending operations, audit, and IT, among others, if they have different rules or regulations that apply to them, or this relationship might creep into their space that they need to make some adjustments and think through that. A lot of times we see at our institutions that they will have, one risk assessment for each of the areas that'll be affected, and then they bring those all together, tally them together, and then finalize their final finding on that potential risk or that potential fintech relationship. When we talk about the rating methodology, we keep it simple here. So I do see people expand on this to be very high, kind of high, low, high, and I like to keep it simple: low risk, medium risk, high risk. And if you want to add color to that, you're more than welcome to here. When we look at our risk ratings on this actual risk assessment, we're looking at the end of the day, we're looking at the potential residual risk that's left over. That means the inherent risk we're looking at is, okay, these are just the natural risks of banking this particular type of fintech altogether. Every institution has the same type of risk, inherent risk usually, because whether it's lending, whether it's deposits, they always carry similar risks to every institution throughout the US. The risk mitigation factors is subjective. It's subjective based on what you believe you've already done to mitigate the risks that are involved with the inherent risks of banking this industry. When we talk about the risk mitigation efforts, we talk about weak, adequate, and strong. You don't have to create the wheel when you're doing the risk mitigation efforts. You need to be honest about what you actually have today, your risk mitigation efforts today. If you're not honest about it, you're not going to know the residual risk that's left over and where you need to fill the gaps to protect your institution. So as hard as it may be to write and be honest about our current risk mitigation factors, as weak as they may be, if you don't be honest about it now, this is going to be the most ineffective risk assessment ever, because you're not going to know your residual risk that is left for you to fill the gaps. And you certainly don't want to be that person that kind of fluffed something up and then left risks out that just didn't get accounted for. When the residual risk is literally the inherent risk minus the risk mitigation efforts. So you're going to end up with low, moderate, or high risk in your residual risk rating. And if it is anywhere moderate or high, then you need to be coming up with risk mitigation plans over here to how you're going to mitigate those risks. So the components that we're going to cover today are these components here. At a minimum, these should be covered. You may have to add additional components in here, but these are pretty robust, so you might be covered here. We're going to look at the customer base of the fintech. We're going to look at the product line and services, geographic considerations, which Jake talked about with jurisdictions earlier, transactional risk, regulatory compliance, and fintech business evaluations. When we talk about fintech customer base, we want to understand who is our customers' customers. Who are they going to be serving? What is their target customer base like? And what we always like to do during our risk assessments is a quantitative and qualitative. We think in quantitative, you can think in numbers. That's our way of saying how often would this occurrence happen with this fintech customer base. If we don't have a fintech yet, or they don't have any data to show us, we can come up with hypothetical numbers there. You know, it's more than likely that X is going to happen with this customer base, or, you know, the population of this area is X, and this is the area that they're targeting. So if they were to bring on 50% of that area, these are the risks with this population area. Qualitative is analyzing that number simply. You know, what is it's a way to give you a comprehensive understanding of the number part. What's the real risks based on the numbers? And then that way you can create a better effective mitigation strategy from there. So we talked about customer segments, risk appetite alignment. Does that fintech's customers align with your target customer base? A lot of times you're wanting to reach out to new markets, that's fine, but you want to make sure your risk appetite aligns with, if they decide they are going to target foreign politically exposed people, and in your policy you say you don't bank PEPs, you got a problem. You don't align there. So you're going to need to ensure that you have a comprehensive understanding of who their target customer base is, who they will and will not bring on as their customers, so you can ensure that aligns with your risk appetite. Reputation and branding, you need to understand how they're going out and marketing for their customer base. You want to, you know, they already have customers, and let's just say they're a fintech that already exists and is looking for a new financial institution. Maybe there's already customer reviews out there, complaints. There may be some CFPB reports that exist out there. You need to understand how they're going to market out to ensure that there's no reputational risk to your institution from you know, their own reviews of their customers using it, that you're going to default by guilty by association, essentially, from the fact that if they're not happy and they find out you're the institution behind it, the activity that could boil up to be something nasty. And growth potential, you want to understand so their target base today, is that the same target base they're looking for on their roadmap 6 months later, or are they looking to expand further? How often are you going to request that they update you on their customer base, because their customer base today may fit your risk appetite, but if they decide to offer another product or service that completely changes or adds a new target customer base, you need to ensure that still aligns with your risk appetite. Anything to add there, guys? Okay.
I would just kind of build on what you said with reputational risk. I remember when I first got into high risk banking, I kind of wrote off reputational risk and said, oh, well, it's not going to come back to us if something happens with our customer. And I think we've seen 4 banks fail this year completely in part due to reputational risk. So, and a lot of the issues kind of spurred a bank run or spurred some financial issues. And so lately, I've been really zeroing in more on the reputational risk of kind of customers that banks are bringing in.
Yeah, absolutely. Okay, fintech product lines and services. You need to understand what the deposit risks are involved in this space. If they are offering deposit type relationships, how are they, you need to evaluate their account opening process, what services are offering, how do they prevent fraud, what's their compliance related to deposits, disclosures and all that. Do they understand what their requirements are there? And then how is your institution differentiating those deposits separately from your other just regular customer base? It's important to understand how that's going to function, because it will shift the way that you're monitoring these types of relationships from an AML compliance perspective. Lending and credit risks. There are way different risks with the lending space. There are different regulations involved. So if they are offering peer-to-peer lending, credit underwriting, loan origination, credit risk management, all of that, there are different regulations that are triggered by that. How do they understand those regulations? Do they understand the requirements? Do they understand marketing requirements for lending? Do they understand their disclosure requirements, how long they have to respond to things, all of that? Understanding those types of risks and whether or not they really truly understand what they have to adhere to. Payment services is its own beast in itself. In some aspects, if you're being a card sponsor, that can be challenging its own way from varying different perspectives. If they're payment processing, funds transfers, mobile payments, and virtual currencies offer varying different risks. Do they know? How do they validate who those customers are sending money to? Do they know the risks involved with those? Do they have OFAC and watch list alerts or searches to ensure that they aren't sending money to somebody who's potentially blocked? That would eventually affect you guys as an institution. Customer onboarding KYC, we've touched on this many times, but it's ensuring, how does your customer know it's customer? How do they verify their positive identity? And how are they adhering to those specific parts of the AML KYC requirements, the CIP requirements? And data and privacy and security risks is all about cybersecurity, data protection, safeguarding customer information. Do they have the proper cyber insurance as well? Do they really understand how that business is? Are they SOC certified? Are they having some type of regulatory overbody look at all of these pieces of the puzzle to ensure that they aren't they are protecting their own customers' information, because that again is essentially your customer. So you don't want to be caught up in somebody having some big data hack or something like that that exposes you guys to some risks in that component. Anything to add to there, guys? All right. We talked about jurisdictional considerations. This is geographic considerations included. A lot of times, again, like Jake said, they may be operating internationally. So you'll want to understand their geographic locations and what kind of oversight is in those geographic locations from a BSA AML perspective. Their high risk locations don't even have to be necessarily international, but there's domestic higher risk areas too, including HITA and HIFCA areas, high intensity drug trafficking areas. financial crime areas. So understanding where they operate and then where their customer base is also located can help you understand their risk profile better. And then the regulatory environment. It goes back to what I just touched on in the fact that where do they operate from and what kind of AML, BSA considerations are over that. And you need to also understand the local laws, licensing requirements, and who their regulators are, if they have any at all. The economic and political stability. So in terms of if they're a US based one, the risks are different than if they're international. You need to understand the potential impacts of their political climate and the economic conditions of the area, which also may affect their customer base as well. So if their customer base is international, you may want to consider those international areas because it could bring up potential money laundering and terrorist financing risks as well. It goes along the lines of the legal jurisdiction as well, as long as cultural and language factors. A lot of times if they're operating internationally, or if they're US based and they only use international contractors, there could be different requirements and potential cultural or language barriers that prevent you from having that type of relationship that you need to truly understand how they're operating and if they are following through the agreements that you guys made. It can also affect their ability to serve its customers and mitigate potential risks if they're operating, if you can communicate with them essentially effectively. Transactional risk is super important to understand in regards to the transaction volume that they'll bring into your institution. So does the transaction types even align with your risk appetite at all? If it's a no, then you shouldn't be banking in this fintech. You may also remember that we just talked about their transactional risk today may not be the same within a couple of months if they've changed their products or services or customer base. So you need to understand the type of volumes because that may affect how your BSA AML monitoring tools or your audit capabilities are for this fintech. If there is a middleware is essentially a software layer that connects the fintech technology and the bank's infrastructure. They're kind of like a side core in its own way. And if that's involved, you need to understand what's it feeding to in regards to a BSA AML compliance monitoring perspective. Does the transactions feed into your own transaction monitoring system for review? Is it an FBO account? If so, how do you differentiate what funds belong to who and who owns what, and how do you determine how to detect for suspicious activity? Does it feed into their own transaction monitoring system like Unit 21? How do you have access into that? What's the requirements there for having access into that instance? So you understand the transaction monitoring perspective from that part. Transaction complexity is important in regards to how are these transactions being facilitated by the fintech. This may affect your operational your deposit operations team, that team over there too, and understanding how do you guys facilitate those transactions and how does that affect how you monitor for suspicious activity. I touched on transaction monitoring above. Some of this may feel repetitive in here, but it's important to think about it in the different contexts of these different key areas. So how are you monitoring for suspicious activity on the actual fintech, and how is that fintech monitoring this suspicious activity on their customers? You need to understand regulatory compliance. Again, they talk the talk. Can they walk the walk? Are they complying with relevant regulations and legal requirements? Do they know AML rules? Do they know KYC rules? Do they know all of that stuff? And then again, just show me the money, right? In that aspect. Show me that you, beyond your policy, that you actually know what tools you have to know that I can feel comfortable that you really are doing what you say you're doing. And then transactional relationships are understanding who their counterparties are, beneficiaries, any exposure to high-risk entities. So if they are serving different areas that you guys might not normally be comfortable with, so let's just say you're an institution that just is prohibited cannabis type of relationships, but that fintech does serve cannabis, that does essentially affect your institution. So you need to be thinking through and understanding who's their customer sending money to, who are they transacting with, do they know how to actually detect for that information and what they should do with it. And then fintech and regulatory compliance here is talking about, do they know the applicable regulations that apply to whatever services or products that they're offering? You know, for example, we had a lending fintech at one point that was just sending all this marketing stuff out that didn't comply with different lending regulations that are out there, you know, with fair credit and lending and all of that kind of stuff. That institution didn't recognize that fintech was doing that, essentially fell back on them, and they were able to remediate it before any regulator caught on. But it's the simple fact that, you know, it's understanding, do they understand the regulations that apply to them, and how are you testing to ensure that they are applying those, what, do they have the proper controls to ensure that they are adhering to those regulations? Again, with the compliance obligations, is kind of along the same lines of that. How do they really act on those regulatory requirements? And also, do they have the right processes, systems, procedures, and controls to ensure that they are remaining compliant? Data collection and monitoring. You know, these monitoring activities, they include, you know, not just transaction monitoring, but how are they escalating those things into cases? How are they determining suspicious activity reports? How are they reporting that in to your institution? How are they collecting information from their client if they need it on a follow-up, because all the CIP information isn't there? So all of that should be reviewed. And they should not only be providing you policies and procedures, but they should be showing you what they do. Reporting processes along the same lines of, if they are the one that are responsible for filing SARs based on your agreement, then you need to make sure the proof is in the pudding, because if it's not documented, it didn't happen. And you don't want them to be telling you they're filing suspicious activity reports when in fact they didn't, and you are now guilty as the institution, the ultimate beholder of the overall BSA and AML compliance program, to be the one that's in trouble. And then we'll go on to regulatory oversight. Who's regulating them? Do they have any cross-border compliance? Are there any of those types of considerations? Meaning, do they do international transactions, and what do they have to, from an OFAC sanctions, all of that? Are they doing any foreign type of exchanges? Do they have the right processes and procedures in place to ensure regulatory compliance from that perspective? From a compliance culture perspective, what's the culture of compliance there? A lot of times they hire somebody as a BSA officer who's never ever had experience in that place. So you need to understand what's their expertise in staffing. We touch on that further down here. And if they've had any regulatory, any regulations apply to them, they have a regulatory body over them, what is their latest exam? What's their regulatory health? And then that also touches on the side of the banking side, which is, do you have the right, your own regulatory rating? Is it satisfactory? If it's not satisfactory, should you be even banking fintechs, because the risks are greater, and you probably should clean up your own mess before you get into fintechs. Do you have any enforcement actions? If you do, probably shouldn't consider banking fintechs. BSA AML audit results, you need to make sure your latest ones are satisfactory, that there's nothing you need to clean up in your own house before you let somebody else move in. Board buy-in is important from the perspective of, has your board been educated? Do they know the risks involved with banking this industry? Do you have the right expertise in staffing? Do you have enough staff? Do you have the right tools? That's where the technology piece comes into play. Do you know, there's going to be things that you have to follow up on with the institution. Do you want to do that manually? Do you want to have a tool in your pocket to help you with auditing and all of that kind of stuff? And then from the fintech evaluation perspective, we want to look at the business model. We want to know what they're forecasting, what their roadmap looks like, what their value proposition is, how well funded are they, understanding that, can they put their money where their mouth is, basically. What's their skills and qualifications? They may be brand new business, but that doesn't mean that they don't know what they're talking about. If they have the right people who have the right experiences, they can bring a lot of value as a fintech to your institution. What are their relevant experiences? what's their capacity and scalability? So if they say they're going to do all these things and they run out here and they build this technology, but then they kind of abandon ship, or their staffing is really small, can they keep up with what they've agreed to do as a fintech and what they've agreed to provide to you? And then there's team stability and continuity, which means what's their employee turnover rates? Do they have the right key employees in collaboration and communication? You need to ensure that you're evaluating how they will communicate with you and what your agreement is there in regards to auditing their practices. At the end of this, you're gonna tally up every section's low, medium, or high rating. And that's gonna tell you your overall risk considerations. Usually it's not gonna be low in this space, and that's fine. A lot of times we end up in the moderate space, which is fine too, because we're acknowledging that there are some risks, but we've got risk mitigation plans put into place. And then right here, you're gonna write a concise conclusion for your board of directors. And I mean concise because a lot of times they have things on their plates and their attention span is short. And so you wanna make your points here very clear and concise on what you do and do not need and what your overall rating is for this. So I know I took quite a bit of time here from you, Jake, for the ROI calculator, but I think it was important to go over all these perspectives. And again, we can talk about them at length individually with you guys if we need to, but for the most part.
That was excellent. In fact, I was sitting here as you were going through that thinking amen to like everything you were going over, all really important stuff. I'll give you just a quick 60-second kind of overview. Let me make sure, can you guys see the ROI calculator on my screen right now?
Yes.
Okay, wonderful. So quickly here, and then we might have a minute or two for questions at the end. This chart right here, and the numbers on the left, those can change depending on the parameters that you plug into this. But the overall message here is, as banks, right, we get paid to take risk, and the more risk we take, the more we can get paid, but the more we have to manage it on the back end. And so that rings true in fintech as well. There's some really big upside to taking on some of the higher risk clients in the fintech space, but there's also a lot of good upside to the low risk clients as well. So we built this chart really quickly. We'll look at the inputs and assumptions here in a second, but essentially what we want to look at is, how many clients do we want? What's that going to result in our total deposits? And then how does that risk profile translate into, let me see if I can zoom out a little bit. How does that risk profile translate into profitability? And how does a vendor like RiskScout or Web Strategies really help reduce some of the costs there? So in here, feel free to toggle with this. If you guys are thinking, maybe I want some lower risk, I want to go bank RiskScout, right? They're on the lower risk end of the spectrum for fintechs. So toggle that over here. It'll show you kind of what kind of what kind of time and resource commitment you're looking at from a staffing perspective. It'll show you over here what you can expect from a revenue, expense, and then just overall profitability perspective. The real message that I see here is whether you're looking at a low risk client, or let me toggle back up to a high risk client real quick, and then you start to see a lot of bigger numbers in here. But automating a lot of these, the compliance process is very manual and very time intensive. And so anytime that you can leverage a partner like RiskScout or Web Strategies to reduce that is massively efficient. And you can see that here just in this example. So, and then I'm going to run through just some of the inputs and assumptions really quickly. These were developed based on, what do I see out in the market as I'm looking at fintechs? This is where I start licking my chops a little bit, right? Because if you look at these high risk monthly account fees, I put $3,000, but I'll tell you, I've worked with companies that pay $15,000 a month just to have a deposit relationship. And so, that's where there can be some real upside to getting involved in some of the higher risk categories here. But feel free to toggle with this. When you look at projected deposit balance per customer, I put in $250,000. You'll open accounts for fintechs that'll put $100,000 in there. I've opened accounts for FinTechs that put 30, 50, 100 million in there. So that's where you have to decide, what kind of concentration risk am I okay with? How much can I take on? And just adjust some of these parameters in here. Anything that you adjust, it's all connected. So as you adjust parameters and you toggle back to your summary data over here, you'll see the profitability projections adjust. You'll see your staffing needs adjust. Pay attention to number of clients. 50 clients with $100 balance, you have to do the same level of due diligence and monitoring as 50 clients with $1 million balance. So that can kind of help you as you set some of your policy parameters. What kind of balances are we looking at? Do we want to have minimums? Do we want to have maximums? I've seen banks go both ways. But play around with this. And then, if you have any other questions about what should this look like from a pricing standpoint, I could talk about that for days. And I'm sure we all could. So feel free to reach out if you have any questions about this or want to follow up on this any further. And if we still have some time, I think maybe a couple of questions.
I think we are just a little bit over time for today. I know we tried to pack a whole lot of value into just 90 minutes, and I think Jake put it well. I think we could all talk about this for days. And you know what? That is exactly what we're here for. If you do go ahead and download that slide deck, we made sure that the last slide in that downloadable is all of our contact information. So if you do have any questions that we weren't able to address on today's call directly, we'd love to chat with y'all additionally after this call. So we'll make sure we reach out to all of y'all individually so you have a recording of this session, all of the links and the handouts for all those additional resources. And so if you do have any additional questions that maybe are better in a one-on-one scenario, we're able to help you out a little bit more. I do want to give a huge thank you to Brian, Kristen, and Jake for taking the time, not only on today's call to actually run through all these assets, but for the hours and hours it took prior to actually develop them, pull them all together, make them look nice enough for y'all to be able to leverage in your own institutions. So hope that brought you a lot of value. As a reminder, we will have another workshop next month, focusing very similarly on the same kind of assets, but instead on cannabis. So we hope to see you there. And again, we will go ahead and reach out with all of these resources just to make sure that you're all good to go on whatever your next step might look like for FinTechs. So thank you all again for joining. Very, very happy to have you here on RiskOut's first ever workshop. We look forward to see you on the next one, and y'all enjoy the rest of your day.
Thanks, everyone.